Hedge funds do you think will be really hurting by this move?
Well, I tell you, on the hedge funds, I'm not sure. I honestly have no clue as to how many are playing this. I think that it's important to note that globally, the Wuhan virus has basically destroyed somewhere between 30 and 35 million barrels a day, right out of 100 of demand. And when you look at U.S. storage, whether you're in Cushing or the Gulf Coast, or even the biggest U.S. production facilities here in Texas, in the Permian, everything is basically full. It's either full or, as your prior guest said, spoken for, and there's literally nowhere to put it. And so on these days when futures contracts expire, you have to be a physical owner. You guys remember what happened to Amaranth, that hedge fund that was trading in the natural gas markets, and it was only a financial markets participant. It wasn't a physical owner of these supplies, i.e. it couldn't store them. So today, if you were to buy this contract and hold it when the market closed today, you actually have to have a storage facility somewhere. Well, they're all full. And the globe is producing way more oil than it's consuming, and now storage is full and they're headed to ships. Well, the ships are filling up, and logistically it's hard to fill up a ship when you're in Cushing, Oklahoma. So now we look to the next month, right? And the next month is a June contract that expires on May 19th. And the real distorting factor here are the U.S., I think the U.S. oil ETFs. You think about just one, USO, owns 31% of the open interest in the June contract. It owns a third of every contract that's out there on that exchange today. And they have to sell those things when the contract period ends.
That's the June contract, not the May contract.
Well, it's important to note that the June contract, actually last trading day is May 19th. So just like today was the May contract, last trading day was April 20th. So it's important to note that, look, whatever the next front month is June, but it expires May 19th. The point I'm trying to make is the next contract, the reason why that market has held up, i.e. the reason that June crude is at $21 a share, or to $21 a barrel, and May crude is at negative $38 a barrel, is this distortion. And by the way, I had multitudes of friends reach out to me today saying, now's the time to buy USO. Crude oil's at $1 or $2 or negative $10. And I said, you have no idea what you're buying. Retail has been plowing into these oil contracts thinking they're buying spot crude oil when they're buying the next front month. So they're paying $22 a barrel when the spot market's negative 38. So retail investors are going to get fleeced if they continue to fly in to these oil ETFs.
Last week alone, I think that USO brought in $1.6 billion in funds, to your point. Kyle, just for clarification, do you have any positions against or in any of these oil companies or any of these oil futures? I mean, just trying to gauge what kind of skin you have, or if you're just observing as a market participant.
No, absolutely. We have been short some of these energy commodities, and we've been short some of these ETFs. I mean, it's important to understand the dynamics of this market vis-a-vis who's playing. And in this case, I think you have the entire retail community is playing into a listed ETF that all it does is buy the next front month futures and buy treasury bills that are in zero. And there's this huge contango market. And all they're going to do is they're going to have to keep rolling that forward and paying higher and higher and higher prices for oil. I think it's actually a disaster for retail investors.
What about, Kyle, for the energy companies out there? And please do clarify, as you said, if you're long or short across the market as a whole, because clearly oil prices are at record lows right now, but we've got the EXXONs, Chevrons, BPs of this world still 20% or so off their lows from a month ago. Does that make sense to you? Yeah, it does, because we have this scenario where our economy, look, we have a $23 trillion economy that's been turned off for about a month and a half, and it'll probably be turned off for the next, call it 30, 45 days as we try to roll and open various sectors of our economy very carefully to try not to get an enormous reinfection rate. But it's important to note that when you look at the curve, you look at the strip
of crude oil. If you just look out to December of 2020, January 2021, crude oil in West Texas is trading for $33 a barrel. I think this is a temporary supply shock that is stressing our system very much like it's stressing our hospital system. It's something that no one ever prepared for our economy to literally turn off, for the world economy to turn off. We have 3 billion people right now that are essentially staying at home or under stay-at-home orders. And so I think as we start to roll and open our economy going forward, I think it makes sense that the big balance sheet, best, most well-heeled energy companies, they're going to be not only the survivors, they're going to be the winners over time. The highly levered, smaller companies that weren't hedged are going to go away. And this is a natural process of what happens when you go from a boom to a bust. And I think we're going to have a bust. But I think it's important to note that the companies that have irreplaceable assets, that have the best production in the best fields, they're going to be survivors and winners. And so you asked me if it makes sense. It makes complete sense to me.
Yeah, I mean, you're seeing some of these players. Occidental down 70% this year. Pioneer down 52%. Others, down so much, Kyle. President Trump has gone to great lengths to pledge support for this industry. He helped broker, or at least reportedly helped broker, that deal between Russia and OPEC and committed the U.S. to it. I mean, the whole world was stepping in to stop the fall of the price of oil. And even if this is sort of technical in nature and a paper loss on a front-month contract, it's a reminder of just how little demand there is for oil and how much supply there is and what the price collapse is going to do. And I'm wondering how you think it's going to impact the politics and the economics of this country going forward.
I mean, guys, it's so easy to see what's happening here, and it needs to be talked about more by people like you. But we're having the largest economic crisis from a percentage of GDP's perspective, maybe that the world's ever had collectively all at once. And that just so happens to be the exact time that Saudi and Russia decide to, quote, have a dispute over OPEC production cuts and the fact that the U.S. shale business has gone from producing, 5-6 million barrels a day to 11 million barrels a day. The U.S. was actually energy independent. And that changes the politics of how we interact with the Middle East and Russia dramatically. And the Middle East and Russia don't like that. So what does MPS and Putin do? They actually declared war on our shale business. And President Trump has been meeting with the oil executives, domestic oil executives, trying to figure out how to defend our national security interest in energy, which is the right thing to do as a president. But unfortunately, there's no stopping the glut, and there's no stopping MBS from loading up VLCCs and sending millions of barrels of oil over here at a point in time in which we don't have anywhere to store it. So this is an intentional effort by Saudi and Russia to put U.S. shale out of business. And we as a country need to fight back.
But Kyle, to what extent can they maintain that? I mean, you made some great calls on national economies in the past, in particular China. To what extent is this actually now hurting Russia, hurting Saudi Arabia, because they rely so much on oil revenues, and in fact be a huge beneficiary for countries like China that are net energy importers?
Yeah, I mean, I think that's a great point, Wilfred. I think that Saudi has a balance sheet that can last years at very low oil prices. Russia is brilliant in their finance ministry. They just let their currency fluctuate. If you remember when oil collapsed at the end of 2014, early 2015, what did the ruble do? They let the ruble move 50%. And next thing you know, Russia's at 2.5% GDP growth again. Russia and Saudi play a long game, and so does China. And we're just going to go through a bit of a bust here. But I think we do have, we have the best innovation. We have the greatest workers. We have a rule of law here. We don't have a tyrannical dictatorship. We know the problems that Saudi has. We all know the problems that Russia has. And God knows we all know the problems that China has. We still have the best organizational structure in the world in our country, and we'll get through this. But in the meantime, I think when you look at the architecture of our marketplace, I think the SEC's got to really take a hard look at why these anomalies are happening with crude oil and with paper, the difference between paper trading and physical trading, and who's getting fleeced. because I think it's very important for them to pay a lot of attention to this over the next few months.
So you said, Kyle, you're betting against energy. Wonder how else you're thinking about this market that has had such a strong and quick bounce off the lows we saw in March on, better numbers in the U.S. and in New York in particular around the virus, but also such huge uncertainties around the economic outlook. Yeah,
I mean, from our perspective, believe it or not, I'm very optimistic about the fact that we have 70-plus vaccines in study. I think the scientific community has literally dropped everything they were working on, and all of our top scientists are focused on the Wuhan virus vaccine. I know that the Gates Foundation says it's going to be 18 months. I'm slightly more optimistic than that, and I hope we'll have a workable vaccine by the end of the year. And I also think that, remdesivir from Gilead and still the hydrochloroquine and Z-Pak are working. So we are going to be able to see the other side of this. I think we're going to see the other side of it in the next couple of months, and we are going to be able to get a rolling opening done. So I'm bullish on the U.S. And by the way, what the Fed has gotten done along with Congress is unprecedented. The fact that we've got $2.2 trillion of stimulus through and we've got almost $6 trillion of Fed programs in. Just think back to the financial crisis and how long it took to get TARP and TALF done. And how today, I think, from a political perspective, we've never been more divided as a country than we are right this minute. And somehow we got this done, and hopefully we're going to get the next few versions done. Remember, again, we have a $23 trillion economy that's, for all intents and purposes, going to be turned off for at least a quarter. Mm-hmm. And that means stimulus is going to end up being, I think it's going to end up being 5 or 6 trillion. And you know me, I'm not a free money for everyone person. I think I'm a fiscal conservative. However, I believe that this is not the time for politics. This is the time to get money in everyone's pockets that's been laid off every 2 weeks, and let's focus on rebuilding our country. And I actually think that both Democrats and Republicans are going to get that done.
Kyle, I get all of that, and that's it's good to hear that optimistic tone. That said, if we snapshot now, S&P 500 is down 12.5% only year to date. Nasdaq's down less than 5% year to date. Given what you just said about large swathes of some of the smaller companies in the U.S., energy companies in the U.S. potentially facing real challenges, does that make sense to you that we're only down 12% on the S&P 500 year to date?
Yeah, boy, you sure know how to find the tougher questions here. You know, from my perspective, you've got the S&P around 2,800 right now, and you know the S&P is probably going to earn about $100 this year. And you would say, well, that's 28 times earnings, and you know clearly it's an earnings trough. Maybe next year we'll be able to put up 140. Well, at zero rates, what multiple do you put on 140? Do you put 20 times on 140? Well, that still gets me to 2,800. And so that's a great question. I think the markets are priced, especially with the S&P, for a great recovery. I've always been of the opinion that we'll have a W. I think we'll have animal spirits rekindled as we start to reopen the economy. And then I think we're actually going to see the difficulties that Main Street companies, small and medium-sized businesses are really having with this crisis. So I don't know if you look out, 2 or 3 years from now, and let's say we're back to $160, $175 in S&P earnings, and maybe you want to put a 20 or 25 on it, then you're back in the high, 32, 3,300s. I think that we've had a major bounce, and now we're going to have a little bit of digestion before we end up moving higher over time.